We have here in the Osney Buy-Side offices Daniel Needham, Global Chief Investment Officer, Morningstar Investment Management. Daniel, you have a really interesting take on risk measurement. I'm keen to hear more.
Well, risk within the industry more broadly, so asset management, investment consulting industry, is primarily measured via volatility or standard deviation using historical return data, so looking at the return of the asset class or the fund manager or the strategy. And people will look at that risk and say, well, this is a high risk investment if volatility is high, or it's a low risk investment if volatility is low. And some people will dress up their measurements with a few little sort of, exponentially weighted, or they might use more complex measures of forward-looking volatility like GARCH. But at the end of the day, it comes off a very similar framework, looking at how much prices or returns have moved around relative to their average over the time period that you're assessing. That's the primary risk measure that I think most people use, and there are derivations off that. Risk for us is more complex in the sense of trying to measure it, but we think we have a pretty clear explanation of what risk is. And we think risk is losing money that you can't make back. And that means for somebody that's going to retire in 5 years' time, if you have a significant loss on your portfolio, that can limit your ability to meet your retirement needs. If you're somebody that wanted to buy a car and you invested in a stock market crash, well, you won't be able to buy that car. So not having the money to do stuff is risk. There's different ways you can lose money, but I'm yet to see high price volatility be the cause of losses. It tends to come from other areas. Areas that are not easy to measure, areas that sort of fall outside of the normal price volatility or return volatility measure, more complex things that are difficult to quantify but are just as important, if not more important, than the price experience. Prices are a reflection of what's happened, and what's happened is dependent on the beginning conditions, the ending conditions, and what happened throughout that period, the economic conditions, the valuation conditions, the fundamental conditions, what regulators did, and how investors behaved. And so prices tell you what happened, and what happened was only one path of an infinite number of paths that could have happened. And so what you're really trying to do is think about the potential things that could happen, and if you use backward-looking risk measures, then you need exactly what happened in the past to happen again to have an accurate measure of risk.
So Daniel, as you say, things like intuition, volatility, these are difficult things to measure, but you've touched upon them in risk measurement. Tell me more about stuff that we can't measure but is critical to risk measurement.
Sure. I mean, I think when we think about what I talked about before was saying that, risk is primarily a backward-looking measure, normally standard deviation or volatility-based, which is based off price patterns, what's happened previously. And so when you think about it, what's happened is kind of driven by how things were at the beginning, how they were in the middle, and how they were at the end. And so that path dependency is quite important. And so when we think about risk, and when we think about the risk that most people care about, it's actually losing money. I mean, that's what really, it's losing money, and normally it's losing money you can't make back, which means that it's been a permanent loss of capital for whatever reason. And so that's how we think about risk. And so volatility has been a way that people try to estimate that, but there are a number of other important factors. For example, we think valuation is critical. If you buy an asset that's highly priced or overvalued, the likelihood that that's a riskier investment in our view is much higher. Whereas if you buy something that's has a low valuation or is underpriced, we think it's on a kind of relative basis, it's less risky. Secondly, fundamentals. So if you buy an asset that's got a huge amount of leverage, that business or that asset is very sensitive to a fall in the cash flows of that asset such that it can no longer repay the debt. That's a risky investment. You've got a business that doesn't have any leverage and has the same cash flow. That's less risky. So you should be looking at gearing, but not looking at gearing as a risk factor, but as a fundamental factor. Also, beyond that, we think investor behaviour, so investor positioning. So if everybody owns the same company, if everybody's talking about the same sector, you've got to buy tech stocks, you've got to buy media stocks, you've got to buy pharma stocks, it's likely that it's a crowded trade, which means that you're much more exposed to a change in investor sentiment and investor behaviour. So if you can combine valuation, fundamentals and investor positioning, I think you've got a much more robust forward-looking assessment of the risk. But each asset's different, each market's different. So you need to look, for example, at the structure of the pricing in the market. So is it a listed market? If it is a listed market, how is it regulated? What are the rights of the buyers and sellers? Is there a clearinghouse? You know, who does the market making? All those kind of things are important. And also, you know, can you get your money out from a regulatory perspective? Will the government effectively stop capital from going out? You need to have a view on that. The UK is very different to India when it comes to those things. And again, looking at the historical price performance of UK equities versus Indian equities tells you nothing about any of that information. And that's what I'm talking about. It should be forward-looking. It's going to require judgment. It's going to require experience. And really, it's having a view that risk is losing money, not how much prices move around. And that's probably the key thing.
If your premise is that a lot of what we are measuring is limited, what advice then would you have for the regulators?
Well, I think it's a difficult question because the regulators have to regulate a whole market. And so I don't for a second think that they have an easy job, but it's very important, I think, that if you are going to apply a framework that's largely driven by one measure of risk, that is volatility, and you're going to use that across a very large number of investors, then one needs to have a reasonable amount of confidence that that's the right measure. And I fear it isn't. And so the second question is, so what do you do about it? I think that we have to recognise that investing is complex and measuring risk is complex, and individual's ability to take risk is very different from individual to individual. And so trying to create this one sort of homogenous system, it's almost like industrialised risk management, risk measurement, and then forcing people to adhere to it, I actually think that's riskier than not having that type of structure. So in some ways, I think if you're paying an advisor to give you advice, you're paying them for advice to tell you what to do, to apply their judgment. And so in some ways, I think it's a complex area. I think what we have to recognise is risk is losing money that you can't make back. I think risk is people not having enough savings to meet their retirement, having to change their standard of living when they retire or finish work. That's risk. There's many ways of measuring that. And I think it's important that we don't get fixated on this one measure of risk, volatility, standard deviation, and then having volatility ranges which we determine asset allocations off and then work out where people should sit off the back of that. I mean, asset allocation is a very poor measure of risk. Equities at times can be incredibly risky, at other times can be a low risk investment. Bonds can be very risky when yields are low and governments are printing money, like now. And at other times when yields are very high and people are pricing in 15% inflation to stay around for 30 years, I would argue that bonds are actually quite low risk there. Unfortunately, the way that we currently measure risk is backward-looking price volatility tends to give you the opposite signal that valuations do. So to me, this is it's a complex area and it's not simple, and I certainly don't mean to make it out that it is, but I think the current framework we use is limited, and I think my fear is that we're going to end up in the same situation we were in 2007, where a lot of investors are taking a lot more risk than they can tolerate, and they lose money that they can't make back. And to me, that's my concern. So what I'm hoping to do is obviously get a debate going around what risk is and how one should measure it, and maybe look at different ways of measuring it.
So Daniel, what are your views on aggregate risk in markets, and over the next year, over the next 5 years? What do you feel?
Well, I think this is where I normally answer these kind of questions by saying that, where our business, our investment strategy is not about predicting the future, and then I go on and try and predict the future. So I'm going to do that. I think right now, people feel very confident. I would say they're much more confident than they have been for a long time, certainly post 2008, 2009. Markets are rising, people feel richer, house prices are rising, people are taking on credit again. And most people think that's good. In actual fact, that tends to be bad. So I think risk in the economy is rising quite a lot. I think central bank policy is incredibly dangerous. I think that trying to re-stimulate an economy that was hurt by having too much debt via increasing debt again just doesn't seem logical to me. Maybe I'm crazy, but that just doesn't seem logical, And so we're in an environment where central banks are printing money, they're encouraging people to take risk. Risk is rising. The margin of safety within company balance sheets is declining, even though people are saying companies have record amounts of cash and Gearing is low. It's low relative to very, very high profits. If profits decline during a recession, then I would argue that some of the credit fundamentals will look similar to what they did in 2006, 2007. So I'm quite concerned about the state of the global financial markets. I think equities are very overvalued. I think credit is quite overvalued. I think residential property, again, in a number of countries is starting to get quite worrying. London and Sydney, again. I think the behaviour of companies, they're looking to increase the gearing on their balance sheets. The quality of corporate debt that's being issued is actually weakening. So effectively the conditions that are associated with the debt are actually becoming lighter and lighter. So it's easier and easier for companies to raise debt. We're seeing more high yield issued now than we were in 2006, high yield debt. So markets have gone up a huge amount. People are more confident. Investors are taking more risk. Credit quality around the world's deteriorating. That's actually not a positive, that's a negative. So I think in the next 1 to 3 years, I think that risks are much greater than they have been at a time when volatility is declining. And so kind of perversely, most people's risk measures are saying everything's good. But I think on a forward-looking basis, risk is high. I'm quite concerned. I think on a 5-year basis, I think people are going to look back at the returns they get from equities and be quite disappointed. And I think they're going to look back at the returns they get from credit and go, wow, how did we do it again? Surely people have learned something from 2008, but history suggests they haven't. And so unfortunately, we're likely to see disappointing returns, certainly from US equities, I think, over the next 5 years.
Yes, history does tend to repeat itself.
It does. Well, Mark Twain said, history doesn't repeat, but it certainly rhymes.
Daniel, thank you very much for coming across to our offices today. We look forward to seeing you at TSAM.
Great. Thanks very much.